Hey everyone, welcome back to Corporate Decoder, the place where we turn corporate filings into plain English. Today we're diving into a semi-annual report, and let me tell you, sorting through all the jargon, it's like trying to find a decent parking spot downtown on a Saturday, except way less rewarding at first. We'll see in a few minutes if this report will be. We are checking out the Alger funds too, specifically looking at the Alger Spectra fund. Here is the quick rundown. It is a mutual fund that invests in other companies, and we are going to look at how it has been doing in the last 6 months, from last November to the end of April, and figure out what all the numbers mean. And remember, if you appreciate getting straight insights from these kinds of documents, make sure you're subscribed. I also started a Discord community linked in the description below to discuss more. First, let's talk about costs, because who doesn't love to save money? For the Alger Spectra Fund Class A, the costs on a hypothetical $10,000 investment were $75. That's 152% of your investment. So for every $10,000 you invest, $75 goes to covering the fund's expenses during the period. Easy enough. Now let's get into performance. The Alger Spectra Fund Class A returned 118%. Unfortunately, that's a negative number, meaning it lost a little money when you compare that to their benchmark, the Russell 3000 Growth Index, which had a 1.82% return. And if we also read the rest of the filing, it seems that even though the return was negative, they actually beat the market. So what impacted performance? The company mentions a few key factors like resilient corporate earnings, as well as an AI-driven capital expenditure wave, which helped. The negative impacts included aggressive reciprocal tariffs and rising economic uncertainty. How did this translate to the returns you see? Over the last year, excluding sales load, the fund returned 18.74%. Looking at the 5-year and 10-year average annual total returns, the fund delivered 12.82% and 12.34% respectively. Just remember that past performance doesn't mean the future will look the same. Some key numbers to note. The fund's net assets were almost $3.22 billion, and it held 69 different investments. Its portfolio turnover rate was about 26%, which means that the fund didn't change its investments too much during those 6 months. Where was the fund investing? Mostly in information technology, which made up almost 48%, and then just over 17% in communication services. So where can you find all this information? It's at, of course, Accession or Alger.com, Fund Leader Accession. Okay, now on to the next fund, still the Alger Spectra fund, however. This is Class C. We see the same reporting time, but different metrics. Now let's talk about all those numbers. Like before, first, let's talk about costs for the Alger Spectra Fund Class C. The costs on a hypothetical $10,000 investment were $113. Keep in mind that last time we had Class A, and now we have Class C shares. This means it has different rates. Now, how was performance? Alger Spectra Fund Class C returned 1.55%, excluding the sales charge. As in the initial result of our first quick dive, it looks like this also beat the base return for the market. So what were the factors that impacted performance? They were effectively the same as the last fund, like resilient corporate earnings and an AI-driven capital expenditure wave, which helped. The negative impacts were the aggressive reciprocal tariffs and rising economic uncertainty. Filings have similar numbers, and the important point really is each rate. How did this translate to the returns you see? Over the last year, excluding sales load, the fund returned 17.92%. Looking at the 5-year and 10-year average annual total returns, the fund delivered 11.96% and 11.65% respectively. What were the key numbers? The fund's net assets were almost $3.2 billion, and it held 69 different investments. Its portfolio turnover rate was again around 26%, 25.53, which means that the fund didn't change its investments too much during those 6 months. Since the funds have very similar holdings, that translates to similar metrics, the main difference being the different price differences of the shares. As before, you can find all of it at, again, Alger.com fund literature. And yeah, we'll do it again. This time is the Alger Spectra Fund Class I. The costs on a hypothetical $10,000 investment were $75. That's 1.52% of your investment. Alger Spectra Fund Class I returned 1.66% for the 6-month period, again beating the base metric of the market. Again, same factors contributing to performance. All this info can be found at SCAP or Alger.com fund literature. We are now on to another fund, this time going into Alger Dynamic Opportunities Fund, specifically Class A. The cost on a hypothetical $10,000 investment were $99. That's almost 2%, $198, extent of your investment. Alger Dynamic Opportunities Fund Class A returned to 40%, excluding sales load. So this one has a positive return. It also looks like that means it beat the market index it compares against. I guess this one didn't have as slow of a season as the Spectra fund. The positive factors were the similar resilient corporate earnings plus the capital expenditure wave like the last fund. However, it seems that the US factors are impacting the performance here rather than the world economic trends, which again is to be expected. It seems that more than the others, this one relies on short positions as well, like the consumer staples and financial sectors, which are the largest detractors from relative performance. Looking at the performance values, it appears that this one does considerably worse than the average index. We are seeing similar portfolio statistics, 114 Carterson holdings, which are similar average. We get nearly 91% of investments with a long and nearly a 32% average. The net portfolio exposure is still only 58%, so it seems that this has very high cash assets at about 42%. What is the holdings composition? At almost 57%, it's in short-term investments and other net chronic assets. In comparison, their next holding is barely 13.2% in industrials. There's something to be interpreted as to why the fund has so much liquidity versus actual equity here. Now on to the last fund covered in this filling. In relation to Alger, you'll find it as the Alger Emerging Markets Fund, specifically Class A. The cost on a hypothetical $10,000 investment was $76. That's 1.55% of your investment. Returning a value of 66%. The Alger Emerging Markets Fund again falls into negative returns like Alger Spectra. We once again see a beat of the market since the benchmark performed slightly worse. It, however, has notably less impact as for contributing factors. The report cites the easing monetary policy cycle and favorable India pro-consumption, fiscal policy being positive with the more known economic fears listed before. Let's look at the performance over the years. Over the last year, excluding sales load, the fund returned 3.69%. Looking at the 5-year and 10-year average annual total returns, the fund delivered 4.26% and 2.33% respectively. This might show that it is underperforming against the base standards that it's meant to be representing. For key numbers, the portfolio holds 39 individual holdings and again 26% turnover, 20 A's for where that allocation comes from. We see more allocation than previous entries into Saudi Arabia and other uncommon economies. The largest position seems to be China at quarter of the investments. You can find more information on the website for each of the funds tab yet. Okay, so what's the story with Alger funds too? It seems they're weathering a pretty volatile market, but the negative returns and in some cases very high turnover might make you question management decisions. There isn't really too much action going on. They seem to be holding on to their equity, so it definitely begs the question of management. And their reliance on the same sectors and a very high allocation of liquidity also begs the question of why you need this manager in the first case, given that it doesn't seem too strong. In summary, it seems that this year isn't the company's strongest. They are doing pretty mediocre and their actions have to be questioned to see why it's still the chosen investment. So, what do you, the viewer, think? Do you disagree with the findings and the decisions that the fund manager made? Hit that like button and let me know. Also, do consider to join the Discord for more financial discussion. Or if you need extra information to formulate opinions on this report. As said, I appreciate the support and will return in due time to provide you with more corporate decoding. So see you then.